people are still kind of stuck in these, fiat currency silos. And they have the continued risks of debasement and siphoning off of value towards the top, and all sorts of problematic cross-border things and censorship. On one hand, it's funny because the more countries try to use the negative powers of CBDCs, the more they make it obvious to people why they would want to leave that system. So it's like the worse they make their product, the better Bitcoin looks. Whereas if they make the product and it's very benign, like say, the United States today or Europe today, like it's our systems in a lot of ways suck, but they're benign enough to a lot of people that they don't see why they need Bitcoin, especially when you have Bitcoin is taxed. Bitcoin has a little bit more of a UX challenge. Bitcoin, when you factor all those things in, people consider the current system workable enough.
Crypto companies and other businesses with significant holdings of digital currencies will get long-awaited accounting rules to measure the value of the Bitcoin, Ether, and other crypto in their coffers, U.S. accounting standards setters unanimously voted Wednesday. Under new rules expected to be published by year-end, companies that hold or invest in cryptocurrency will be required to report their holdings at fair value, a measurement that aims to capture the most up-to-date value of an asset, including rebounds in value after prices dip. While the new standard will inject volatility into the earnings of companies that are heavily invested in crypto, the ability to record recoveries will be an improvement over the current practice, companies and accountants have told the Financial Accounting Standards Board for months. The rules will go into effect as soon as 2025, but companies will have the option to apply them early, FASB agreed. It's a great step forward for the entire crypto market. I think it's a great step toward mainstream adoption, said Jeff Runlet, head of the accounting strategy at accounting software company Crypto. I can see this finalizing this proposal to help large corporations that are maybe scared to hold crypto on their balance sheet because they're scared of the technical complexities. Lyn Alden takes on the role and dives into the core principles and use cases for Bitcoin in the always-changing financial system. She also highlights the long-term impact of Bitcoin and what she thinks are the risks Bitcoin faces. Let us now delve into the video. Make sure you hit that like button, subscribe, and drop your comments below.
For thousands of years, basically, humans have been trying to make gold and silver easier to use, right? So they have various divisibility or transportation limitations. And so for thousands of years, proto-banking has been a convenience tool over that. And in the past several centuries, full-service banking has been a more elaborate tool over that. But the problem is that increasing level of abstraction basically caused major issues between the amount of claims for those metals and then underlying metals. And then this all expanded dramatically during the telecommunications era. So ever since the telegraph became implemented throughout the second half of the 19th century. And during that environment, they were eventually able to just drop precious metals altogether. And so we've been in this system where physical money is too slow to deal with the modern global economy, but these fiat currencies are too arbitrary, inflationary, and have other issues to serve the similar role. And of course, the problem is far more compounded in the long tail of developing currencies, because the current market is basically 160 different fiat currencies in the world. The top handful lose value slowly, and then for most of the others, wherever you are born in the world, you're in this like little currency monopoly. And if you happen to be born in a bad one, then accumulating capital is way harder than it should be, and all the global payment frictions are way harder than they should be. The challenge is that most of these solutions that made money easier to use were centralizing. Mm-hmm. And with centralization comes corruption and basically more ability to play games. And so what I think is relevant about Bitcoin as, the first time where hard asset, bare asset money can move at the speed of telecommunications globally. What that does, it's one of the first technologies in money that can improve it that's not centralizing, that's arguably decentralizing. And that's what makes it different than, say, the past 200 years of monetary innovations. And I think the challenge, what we talked about before, the concept of technological determinism, which is that, if we were to rerun humanity multiple times, would this be like a weird anomaly that happened, or would it usually end up like this? And my argument is it would normally end up like this, like the set of technological capabilities combined with incentive structures and human greed makes it really hard to run a money system when transactions can move at the speed of light, but physical settlements of hard money can't. So this century and a half window is a weird window to navigate, but it's a window that would come up over and over again for any civilization that reaches this type of complexity. And what's interesting about Bitcoin is it's potentially the closing of that era. If it's successful in the longer run and at scale, then it's the first time where digital settlements are just as fast as digital transactions, basically, and that can de-abstract, simplify, and decentralize the money system. The challenge from Bitcoin, and one of the things that the critics have pointed out from the beginning, is that no one stops you from making a duplication of it. There's no limit to how many different cryptocurrencies can exist, and so they rely on network effects, depth of liquidity, their own unique properties to establish such a degree of dominance that near identical new entrants are not really going to have a chance. Right. And so this is kind of this bootstrapping period is this phase where we see if the technology is strong enough to resist all those types of challengers and establish a certain degree of network effect and liquidity and dominance and all that in order to become truly scarce and gold-like. And again, I would defer to technological determinism in the sense that I think anytime this type of technology gets developed, if we were to rerun these past 15 years multiple times, I think you get an explosion of shitcoins like every time. I think we were lucky that the first one was good. I mean, I can imagine worlds where the first one was not good and like it had some sort of big flaw, or Satoshi's a scammer. He's smart but not ethical. And you can imagine different scenarios where maybe the second or maybe the first one's not the one that achieved critical mass. But we were in one where it is. But I think it's natural that people are going to experiment. I think we have to try all the wrong answers to prove why the right answers are they are.
The Federal Reserve is expected to adopt a gradual and cautious approach to developing a central bank digital currency, CBDC, according to a report by RBC Capital Markets. The report published on Wednesday analyzes the potential implications of a U.S. CBDC for the financial system, the economy, and the Fed's monetary policy. The report also compares the U.S. approach to that of other countries, such as China, which has been aggressively testing its digital yuan. Lyn Alden dives into how CBDC pose a risk to Bitcoin and why the Fed would do everything in its power to make sure Bitcoin doesn't survive. According to Lyn Alden, it can only slow it down but can't stop it. Let us get back into the video.
So I think that there are a handful of risks. I think that, as we talked about earlier, that dilution risk has always been a major risk. It's always the question of, is Bitcoin good and unique enough to crowd out everything else and to achieve a depth of liquidity and network size that makes it uncontestable? And so far it's been able to do that. It's only ever really had one challenger of anywhere near the same scale. No other one even comes remotely close. And so it's so far it's done very good in that track. The other areas are, if major governments got very aggressive on Bitcoin, like if you had the United States and Europe just kind of take their gloves off and just try to go full, like just try to kill this thing as much as possible. I don't think they'd be successful, but I think they could slow it and cripple it enough that it could greatly extend. Basically, all the risk would massively amplify, and the duration of the whole project would be extended. Now, part of the incentive mechanisms, especially in relatively free societies, is that there's a lot of mechanisms that prevent that from working. When we look back at the era of America's gold ban from the 30s to the 70s, they did that with a supermajority. So FDR, when he came into power, at one point in Congress, he had something like 70% of Congress was on his side. That was kind of an unheard of level of concentration of power, like a supermajority. So that's more of an exception to the rule. It's very hard to do that kind of thing without that sort of unusual supermajority in these types of countries. So it's something I monitor, but it's something to consider. But I think in some ways another risk I look at is the supply chain risk. So the fact that only a handful of foundries in the world make high-end semiconductors. This is not just a Bitcoin problem. This is like a tech concentration problem, especially given current geopolitics. But one of the clever ways governments could try to attack it is going after the supply chain, and control the production of ASICs. That's one of the weak spots. And then I think lastly, it would be things like unforeseen technical bugs that are bad enough to damage Bitcoin's reputation. So if there's been bugs in Bitcoin's past. Luckily, none of them were catastrophic, either because they were fixed quickly or ahead of time. Over time, the code base is hardened, but there's still ongoing risks of any sort of live project. And then, of course, there could one day be a quantum threat, and then there might have to be some sort of fork to make it resilient to that. And that's like a period of time. Anytime you have to change, that'd be considered like a shields down moment. Like there's a period of vulnerability there where consensus could differ. There could be schisms. There could be challenges to make that possible. So I think it's not a risk-free asset. It's something that has to be monitored, but that I think all the pieces are there, and I think it at least has the tailwind of technological determinism on its side, which is not necessarily to say that Bitcoin has to win, but that this kind of technology I think is in some ways inevitable, and if you kill it, it'll try to keep coming back. It's something that exists now. It's out of Pandora's box.
No part of the rule book for U.S. accounting specifically addresses how companies like enterprise software maker MicroStrategy Incorporated, automaker Tesla Inc., or crypto exchange Coinbase Global Incorporated should recognize and measure the digital currencies they own. Companies currently default to an American Institute of CPA practice guide that treats most cryptocurrency as an intangible asset, a category that includes things like trademarks, copyrights, and brands, all items that, unlike crypto, are rarely traded. This means companies record their crypto at the historical price they paid and assess their holdings every quarter for impairments or value declines. If the price of Bitcoin drops even briefly during a period, it's considered impaired. Companies can't revise values upward if the market recovers. This accounting method routinely dings the earnings of MicroStrategy, the largest public company holder of crypto. Fair value crypto reporting would enable us to provide investors with a more relevant view of our financial position and the economic value of our Bitcoin holdings, which in turn would facilitate the ability of investors to make informed investment and capital allocation decisions. MicroStrategy CFO Andrew Kang wrote to FASB in May responding to the board's original proposal. The accounting rules will be mandatory for all companies, public and private, for fiscal years beginning after December 15, 2024, including interim periods within those years. This means 2025 adoption for calendar year-end companies. Companies will be allowed to adopt the rules once FASB formally publishes them later this year. In addition, they will disclose in their footnotes every reporting period significant holdings of crypto and any restrictions on those holdings. On an annual basis, they will have to reconcile or disclose changes in the opening and closing balances of their crypto assets broken out by category. They will not need to include within the reconciliation activity information about crypto assets received as payments and immediately converted to cash, FASB agreed Wednesday. In addition, since crypto will be measured at fair value, companies will be subject to the disclosures required in the applicable accounting rules ASC to 20, so financial statement readers know how companies came up with their measurements. What do you think of the rules by the FASB? How does that affect Bitcoin price projection? Let us know in the comment section below. Also, don't forget to hit the like button, subscribe, and turn on notifications. Thanks for watching.